Welcome to the monthly market update for May. Now, we typically do these quarterly, but we've decided through this pandemic to try to do these monthly because there's just so much information coming at us that we need to get it out on a more frequent basis. So that, and there's a lot of insecurity out there, and people just really want to know what's going on. So let me just start with the indexes. As of the end of May, at the very bottom, you can see here S&P 500 down just about 6% year to date. The Dow is basically down 11%. And then you got the NASDAQ surprisingly up through all of this, which would stand to reason because we're all depending on this technology while we're at home, staying at home, working, and the like. Now, I thought this is interesting. This is the S&P 500 over the last 1 year. There's a lot of people that feel we've had this bounce back. It hit the all-time lows in March, right? Lost like 34% in a 2-week period. And now we've had what's called a little bit of a bounce back, all right? But it hasn't quite got back to where it was at the start of the year. Well, this has caused a lot of people to want to just hold on because they're waiting for it to get back to where it was. And I just want to make this case. I drew a line here, you can see all the way back to September of last year. Now remember, we kind of had a run up in the market in that fourth quarter. And say if you take that out, or if you go back to the end of September last year and look where we're at today, we're basically right back where we were. So you have a lot of these people holding on, waiting for comeback, and I'm saying you're already there. You know, if you have any concerns, you want to maybe protect or preserve what you have. You haven't lost anything if you look back to September of last year. This is again talking about the sectors that have done well. Technology obviously 2.4%. Now this this was as of May 15th. Healthcare only down 1%. Energy at the far end there down 39%. But what's skewed here is, you got to understand that technology and healthcare make up a little over 40% of the S&P 500 in general. Energy, that last sector, maybe makes up just a little under 3% of the S&P 500. So that's what's skewing things a little bit. Thought this interesting. This was through April, but if you look Facebook, Amazon, Apple, Microsoft, and Google, just those 5 stocks alone, and as the end of April, you were up 10%. The other 495 companies that make up the S&P 500, though, down 13%. So you can see the disconnect here. Now, speaking of Amazon, look at online buying. That's that dark line at the top of that green there. You can see that's been growing over the years, but now, with this pandemic is doing super well. I think Amazon hit its all-time high here just a couple days ago as of this airing. So that all being said, and then you've got Macy's, Gap, Nordstrom, Kohl's, Bed Bath & Beyond, Foot Locker, all the like heading for bankruptcy. Crazy how things are changed. What's going to be real interesting to see is at the end of this pandemic, when we get things to somewhat new normals, what's that going to look like for retail box office stores and the like. GDP growth, you can see at the last estimate for the first quarter was down 5%. The estimate so far for this quarter is down 51%. Now, the definition of a recession is when you've had 2 quarters in a row of negative GDP growth. I believe we're there. We're in recession, and it began with the pandemic. That was the trigger. But 51% drop to our GDP. That is, that's crazy to even think about. Crude oil prices now at the end of May were $35 a barrel. In last market's update, I think I shared with you, we even got into negative territory for the barrel. Now imagine that. You couldn't sell it. You were having to pay people to take it away from you. Okay. That was crazy. But that happened, and I explained last month, because speculators are in the oil futures market. And when it got to the end of the month and they did not want the oil, all right, they couldn't get, and nobody wanted it. They had to basically pay people to take the contracts off their hands. So it went into negative territory, but quickly came up to about $19, $20 a barrel, and now through May has got to $35 a barrel. Now with openings happening with states. You know, you're going to see more people driving, and I think consumption is going to start to rise again, and we'll see where this goes. But I think last I knew, oil companies couldn't even make money till they got, you know, above $50 a barrel. So it's hanging down at these levels, that's not good for them. U.S. consumer sentiment just dived, you know, that first 2 months with this pandemic, but now they're just slightly in a little bit of an uptick. So we'll see where that's going. You can see here the blue line is consumer confidence. That yellow or orange line is basically consumer spending. So their confidence is rising, their spending is certainly going down, which is attributing to why we have 50% negative GDP growth. You got to understand, GDP is made up 70% of consumer spending. So when that drops, certainly has an effect on GDP. This is the American Association of Investors, basically. And if you see to the far right where it says 100, that's where the investors are absolutely 100% confident in the market. They're optimistic. 0 would be totally pessimistic. So anything that's like that red dotted line going across, it's like around 65 or above, that's what you call extremely optimistic. Anything below that green line is what you call extremely negative or pessimistic. And right now at the end of May, it was at 32, which was at extreme pessimism. So you got a weird situation. You've got the market, you know, going up, and then you've got pessimism going down. Just a huge disconnect there. Small business optimism, you know, dropped significantly, as you can see. The S&P 500 PE ratio. Now, for right now, it's at about 20. Now, we watch PE ratios because the market, for the most part, follows earnings, and it trades at a multiple of those earnings. So historically, it's traded at about 17 times earnings. That's kind of where it kind of falls. Now, of recent years, it's been a little above that, and a lot of people attributed that to being sustainable with the interest rates as low as they were. Right now at 20 wouldn't basically show anything that we should be concerned about. But you have to understand, this is looking in a rearview mirror. It's looking at earnings over the last 1 year, which, you know, were a lot better than they are today, right? When you look forward at what the earnings are going to be, it's a whole different story. Look at this chart. Now that red line is long-term expectations of earnings growth, earnings per share growth, okay? That dotted line above that is the 12-month forward-looking price to earnings, okay? You can see right now the difference between the two is almost 2 times. Now, it's already, the market is even overvalued when it's at 1 time, but at 2 times, extreme valuation. Now, this one, speaking of forward-looking PE ratios, if you look here at this top line, the Russell 2000 index. Now, the Russell 2000 index is small company stocks, okay? And if you took to the far right there, you can see it says the PE ratio estimate going forward 1 year is 62. That means it's the Russell 2000 or smallest company stocks are trading at 62 times what is expected for earnings. Folks, that is way, way, way high. So I dare say I don't know where that's going, but it sure seems like a huge bubble there. Again, if you look at this dark line, solid line, that's a forward-looking earnings per share, okay? And you can see that light blue line, that's the market. So again, if the earnings are on the rise, the market's going to, you know, follow pretty close along with it. But look at this of recent. That forward-looking earnings per share has dropped to almost $140 a share. All right, and then you see the blue line up where it's at. Now, if you follow that $140 per share to the very left of the chart, that takes you to an S&P 500 that's supportable around 2,100. Well, as of this recording, the S&P 500 is around 3,000. That's, for the most part, that's a 33% drop in the market from where we're at right now. This is the VIX rate. This is what they call a volatility index. It's basically an algorithm for, you know, how volatile the market's going to be over the next 30 days, okay, to the good or the bad. So a VIX rate of 20 means they expect the market to do 20% to the good or 20% to the bad. It's basically how wide the outcomes are low the outcomes are going to be. Historically, the VIX rate's been right around 20. You can see that with the pandemic, it got as high as 80. Now it's down around 28. So we're still, a little bit more volatile than where the average is, but we definitely want to be paying attention to this. The Feds, you look at this chart, they started off with $1 trillion balance sheet since the last recession. And then you can see all through the last 10 years in this recovery that we were in, this bull market, they were raising that balance sheet. A few years ago, they tried to taper it back, and then they quickly reversed course when the market started going south. And then now with this pandemic, they're throwing, I think, as of this recording, they've thrown $3 trillion at this. We're now at a balance sheet of almost $7 trillion, and now I think the government's talking about another $3 trillion. It's just crazy how much money that's been thrown at this. You can see here that this chart, about 26% of our expected GDP for 2020 is now gone out in Fed money or stimulus. I think this chart really puts it in perspective. You can see the dark boxes the very far left, and then you got the purple and the pink. That's all the debt. That's a visual idea of how much debt has been added to the balance sheet over this period of time. I want to talk about something I saw a commentary on, and I'm kind of buying into this myself, and I think the Feds have kind of put themselves into kind of a bad spot, or what we would call a liquidity trap. Okay, I'm going to show you in a moment, but M2 money supply has been going down for a number of years now. Now, M2 money supply, all that is the velocity of money. Okay, when I give $1 to somebody, and then they give $1 to somebody else, and they give $1, it's the multiplication factor of that money and velocity of money that gets kind of moved in through the economy. And that's been going down for quite some time, despite the fact that the Feds have been throwing all this money into the market. And then you've got savings rates going up. I'm going to show you that in a moment on a chart, how that's been going up. So what does that mean? Well, if you got the velocity of money going down, you got savings going up, basically that means spending's going down. Okay, and if spending goes down, you got earnings, corporate earnings are down. And you got corporate earnings go down, now you've got bank defaults, right? Companies can't make it, not being able to economically make it, so they're defaulting. Now banks start to tighten up their credit because they've got these defaults that are rising. And then what you get with a period like that is you start to get deflation, not inflation, but deflation. And then with the deflation, you have low interest rates. Now, here, imagine a situation, you got low interest rates, you can't print any money because it's not stimulating the economy, it's not doing anything. The Fed's got no handles to pull at this point, right? There's nothing more they can do. Let me give you another scenario. Let's say it's not that, but now let's say we get that V-shaped recovery people talk about, right? We get, everything opens up and we're back to pre-pandemic levels. Everybody's working again, and everybody's got this money they can spend. So spending's up, earnings go up. Now you got an opposite situation. You don't have deflation, you've got inflation. Now with inflation, interest rates go up, but now you have a different scenario. You got all these companies that have taken on all this debt, and now with interest rates rising, they can't pay the debt, and so you have bank defaults rise, right? Now the Fed's got a different scenario. Now you got interest rates going up. This is a time when you don't, and you got inflation. This is a time when they don't want to be printing money. Okay, but they have to, because they have to support the debt, all the debt the government's incurring each year. So I just think they're painting themselves into a corner here, and I just dare say it's not going to look good for the long haul, especially. Again, here's that M2 money supply. I was showing you that orange line. Is it going down over time as the Fed rate has been going down? And then this was you can see savings basically on the rise. But I want to talk about this savings. It can be a little bit deceiving. That blue line there, that blue bar, is basically the top 1%. That red bar is the next 9%, but that gray bar is the bottom 90%. Okay, and you can see that the savings rate for the bottom 90% has been negative. So what's that tell us? That tells us they're basically spending everything they're making. The bottom 90% is we've been throwing all this stimulus money in for this pandemic. Okay, they're not hoarding and saving this money and putting it aside. They're having to spend it to get by. I dare say all this money that was put in there might not be stimulus. It might have just been relief. And when we get to the other side of this, there's not going to be all this pent up savings that they're going to be able to then just put right back into the economy. So, just something you want to know. Unemployment, look at this, just skyrocket. We had, it was at the lowest it had been in 70 years, and all of a sudden this pandemic, and now I think as the era of this recording, it's 40 million people unemployed, and which is basically 20%. We went from 3.5% to 20% in such a rapid period of time. It's crazy. Now I know University of Chicago just did a study, and they figured that they estimate that 42% of the jobs that have been lost during this pandemic are not coming back. Think about that, folks. 42%. That would be 16, 17 million jobs not coming back. To put that in perspective, with 2008, we got as high as 10 million jobs lost. This is way above that. So don't know what that's going to mean, but that could be not good if that's true. Top 1% have seen nearly 300% of the increase in wealth since 1989. But again, look at that blue line, the bottom 50%. Haven't really seen any increase in wealth in this period of time. Share of U.S. mortgages in forbearance since March 2nd on that chart on the left. You can see that's just been on the rise. Now, forbearance is where people have asked the bank to have their payments delayed, right? But you look at that situation on the right, that chart on the right, with unemployment come bank mortgage delinquencies, right? So if that's true, that study at the University of Chicago came out, and that unemployment number does settle in around 16, 17 million, you're going to see mortgage default rates definitely on the rise. This is just a 20-month exponential moving average. That's that solid blue line you can see across there, and then the red line is basically the market. You can see that it dropped below the exponential 20-day or 20-month moving average, and when it's below that line, we're basically in bear territory. So it did drop below, and then just lo and behold, here right at the end of May, it dropped. It kind of touched the line again and just actually exceeded it just a little bit. But if you look back the last couple times this has happened when we've been in recession, it's not unlike that to do that. It drops down and comes up to kiss it, and then and in the past, the last two recessions, it then took a pretty big drop downward. So right now it's just kissing line, but something we're definitely going to want to be paying attention to. The Buffett indicator, Warren Buffett loves this one. Basically, it's the value of the market divided by GDP. He feels like when it's at about 1, that we're starting to enter, overvaluation. Right now, it's the highest level in 50 years. And I had a quote. Warren Buffett just came out with his annual meeting, and he basically, in the past, when we've had these recessions, he's been a buyer in the market, and he hasn't been. He says, even at Buffett's digital-only meeting this past weekend, while warned investors never to bet against America when speaking about whether he is currently buying stocks, he noted, "We have not done anything because we don't see anything attractive to do." And then later, he said, our position will be to stay a Fort Knox. So you got Warren Buffett sitting on $137 billion in cash. He can't find anything with value in there right now. Something we want to pay attention to. Retail money funds. This is basically mom and pop investors. You can see the gray bar there has been the last recessions, and what these retail money funds are is really money market accounts, okay? And you can see that when we get to recessionary times, these are at peak levels because they're basically parking their cash in money market funds till they get to the other end of it, and then they start releasing it. You can see right now, you don't see a gray bar for 2020, but I dare say we probably are in a recession, and look where the savings rates are. So it's not mom and pop investors that are driving this rally. Companies issuing a record amount of bonds in March and April. Crazy. I think, with the market, I think Disney's been one of those. You can see that high yield is that blue line, and then you got investment grade as a green. You see that for April of this year, the green line investment grade stuff has been on the rise. Like I said, for companies like Disney and all that getting into the bond market. And you might want to ask why that is. Well, money is cheap right now. If you look at this chart, this is that ROIC, that column, that's return on investment capital. Okay, and take that HD, that's Home Depot. So for their capital, they get a 40% return, and you follow that to the far right. Their after-tax cost of debt is 1.72%. So getting a 40% return on their invested capital, and it's only costing them less than 2%. That's a no-brainer for them to, take on that debt. Look at that PM. That's Philip Morris, 47% return and costing them just a little over 2%. And that VRSN, that's VeriSign, 174% return. So there's good reasons these corporations take this debt on, because if their return on invested capital is so much greater than what it costs them, they're going to do that all day long. Just looking at this chart, I'm going to talk about this in a minute too, but everybody expects that a lot of this market rally is in hopes that the market's going to recover very quickly. We're going to get right back to pre-pandemic levels very fast. And I dare say, looking at this, you can see this is people nervous about getting back in, even if it opens up. And for the U.S., look at that, 67% are going to be very nervous. They're going to be very slow to re-enter. And I said this last month, and I'll just say again, and I heard a commentary of this, and I think it's going to hold true. You're going to see 1/3 of the people jump out there right away when it opens up. I think of recent, we've been kind of seeing that already in northern Michigan when it opened up. Look at all the activity that happened. There's going to be another 2/3 going to sit back, though, and wait and see what happens to the 1/3, right? And then another 1/3 will slowly start integrating back in as they see the coast is clear. But there's another 1/3 that they're going to wait quite a while. They're older, they got health issues, the coronavirus is still out there, they can't get it for health reasons, they're very susceptible, so they're going to be waiting a lot longer. So I just don't see this quick bounce back, even when things open up. I see it being very, very slow. Now, I've talked about this, and there's what I call 3 stages in a bear market. You have that panic selling. Well, that was at 2 weeks in March, where it dropped 34% in a 2-week period, right? And then you get this, we've had this bounce back, and it's what we call the kind of buying the dip. People think the market's down, they're trying to take advantage of it, they're hopeful that this is going to be not going to last long, and they start bringing it back up. And I think that's where we find ourselves today. But then there's a 3rd stage, and that's that stage where the reality of this, earnings start to come out, market retests the bottom, let's say, and all those people that were hopeful that it was going to go back, and they're buying the dip, have lost money, and it gets to a point where when you hit the bottom of a bear market, it's when you don't think it's ever going to come back. It's kind of like a despairing feeling. Nobody wants to get in. And it's typically when you get to the bottom. Well, we're hardly there yet. I'd still say we're kind of in those middle stages. Now, how I kind of know this to be the case is you look at this chart. It's a smart money confidence versus dumb money confidence. Now, smart money is basically good market timers. Dumb money is basically bad market timers. And you can see in the yellow line, that's the dumb money confidence was rising, while smart money's confidence was going down. So you just have a lot of those people that sitting at home, they want to get into stocks, and they think they're missing out because they've been watching the market kind of bounce back, and they're jumping in, and may not be the wisest thing to do. So what's the roadmap? The roadmap really at this point, I believe, is to stay defensive. Preserve what you have. This is not the time to speculate. I think this market, if certain scenarios play out, could find a new bottom, retest the bottom that we saw before. Now, going to be a huge opportunity on the other end of this, but in the short run, some people could get hurt very badly. So what we want to, stay defensive. We want to look for that final stage in the bear market when, things are kind of hitting a bottom. You won't be able to time it perfectly, but you can get you can get pretty close. We want to see some good news on the pandemic front, whether we have a treatment or now soon to be made vaccine, because that means things are going to start getting better a little bit quicker. And so again, when we get on the other side of that, if we've done a good job staying defensive, then that'll be a great time to get in and take advantage of what should be a good recovery. But folks, there's no precedence here. I read a lot of commentaries and news, especially on market stuff, and the outlooks are all over the place. We are certainly in uncharted territory. We've never had a situation when the Feds have had to throw so much money at this, and we've had to literally globally shut all the economy down. So there's no precedence for this. There's a wide range of outcomes that can happen, and with a wide range of outcomes comes a lot of risk. So we want to be very careful. Again, unemployment, very, very high right now. If that's true, that University of Chicago study that 42% are not coming back, I dare say I don't know what that looks like. And I just want to pose this one last question. There's a lot of hopes that we're going to get back to pre-pandemic levels. But I heard this commentary and I just want to share it because this really summed it all up for me and hit home. He said, if we got back to 70% of the pre-pandemic levels, would you think that would be a good thing? I said, yeah, that 70% sounds like real good start. How about 80%? He says, let's take it as far as 90%. If we could get back to 90%, would you be happy? Would you think that would be very optimistic? And I'm like, that would be great. He said, that alone is a 10% drop in our GDP. Now, to put that in perspective, in 2008, we watched the market drop to half its value and GDP was down 4%. Now we'd be down 10%. What does that look like and couple that with that high degree of unemployment? That's not going to be a good scenario. Honestly, we need to get to 100% pre-pandemic levels. But I want to say this, and I showed you in that chart earlier, earnings have been flat. In 2019, the first 3 quarters, we came off 3 quarters in a row of negative year-over-year earnings growth. The fourth quarter was up, but it was less than 1%. Earnings were already flat. I was already expecting the markets to pull back or correct before the pandemic came, but now we get the pandemic. If we even get back to 100%, I'm saying it wasn't even good then. So we want to be careful here. We're all riding hopes that we're going to, whatever the recovery ends up being, or however fast it ends up being, things are certainly going to be volatile for some time. So we want to be very, very careful. So hopefully you found some value in this. If there's any questions you have, anything we can answer regarding this, then certainly give us a call. We'd be glad to do that. I expect to do another market update at the end of June. That'll be our legitimately quarterly market update. So anyway, thanks for joining. Again, if you have any questions, certainly let us know.